All right, so I'm just going to jump right now to gift and estate tax planning. This is an area that has been extremely, liberal as far as the amounts that you can pass via gift or through an estate to an individual. One of the areas I mentioned before is the gift tax exclusion is $15,000 per donee. You can give, double that amount with, with your spouse, and you consent to gift splitting. It can come from one individual. One of the items that does not, have any limitation with regard to the $15,000, you can make a payment directly to a medical institution for medical expenses for the child or grandchild, and it does not count as a gift for gift tax purposes. You can do the same. You can pay, tuition for a child or a grandchild, and it does not count against your annual gifting ability. So those are areas between the annual gift as well as paying qualified medical expenses and or education expenses. So from a wealth transfer planning perspective, we have a significant exemption that every taxpayer has the ability in this year to transfer $11,580,000 to a non-spousal beneficiary. If you're married, $23,160,000 that you can transfer to non-spousal beneficiaries. Note that this was part of the Tax Act that is set to expire December 31, 2025. So January 1, 2026, the exemption will drop back down to about 5.5 million, indexed to inflation from 2017. And so that is something that's on the books right now. At the beginning of the year, the IRS came out and said that if taxpayers utilize the large exemption, and in the future the exemption decreased back, let's say, to 5.5 million, there would not be any negative tax impact or clawback from the excess exemption used. So the IRS came out and said that feel free to use this exemption. We're not going to claw back any excess if the exemption drops. Now, that's the estate and gift tax exemption. That's also the generation skipping transfer tax exemption. That's the amount that you can transfer to one generation below your children. So it typically applies to grandchildren, great-grandchildren. There's an exemption against tax, and that's really beyond the scope of what I want to discuss, but realize that that's some planning to do it as well. The tax rate's the same both now and when the tax law changes in 2026. And one of the notes I put at the bottom of the slide is right now when a beneficiary inherits an asset, they receive a stepped up basis to the fair market value the date of death of that asset. And so if there was a gain in that asset and the person who owned the asset dies and passes it on to a beneficiary, that beneficiary will receive a stepped up basis to the fair market value and could turn around and sell that asset without any additional capital gain tax. That's our current system. So we'll talk about what may be coming, but what strategies should we be looking at with such a large estate tax and gift exemption? Particularly, we're also in a very low interest rate environment. So right now, what we are looking at for our clients with, significant estates that might, be subject to an estate tax if the exemption were to be decreased, is taking a look at, has there been any reduction in value in investments due to the market? And using that as the ability to use the annual gift tax exclusion, or a used part or all of that large exemption now, that $11,580,000. there are certain types of strategies that work well in low interest rate environments. Grantor Retained Annuity Trust is one, and we're going to actually talk specifically about that strategy. Interfamily loans is another way to transfer wealth. The federal government publishes something called an applicable federal rate, and it's published on a monthly basis. And right now, those rates are as low as 1/4% to 0.4%. So there can be a way to transfer funds to family members at an extremely low interest cost. And sale to an intentionally defective grantor trust is another way, with the interest rates that are as low as they are, to transfer substantial wealth with very little gift or estate tax consequence. Now, trusts, I think, are valuable planning tools. Your estate is going to be taxed depending upon where the value is at the time of death. Right now, with such a large exemption, realize it's going to drop. How soon, we're not sure. But we call it the tax fence and getting assets over the tax exempt side. And what's nice about trusts are, you can have certain strings attached to yourself. When they pass to children or grandchildren, you can keep them from the claims of creditors, divorce or other liabilities that could be protected from, and the same holds true for grandchildren. So bloodline trusts, dynasty trusts, we certainly think that's a great planning tool for the right estate. This was a popular strategy back in 2012 because back then the estate exemption was to drop from 5 million down to 1 million. It was called the fiscal cliff, a lot of expiring tax breaks. The Spousal Lifetime Access Trust, also called a SLAT, is the ability for one spouse to transfer assets into trust for another spouse. We call it the grantor spouse and non-grantor spouse. And the grantor spouse would transfer assets, and the non-grantor spouse would be able to use those assets for their lifetime. And the way that SLAT is created, it is a taxable gift, and the assets that are contributed would no longer be in the tax system. So that is one way to utilize the current exemption. It's one way to keep a string attached with the non-grantor spouse, and then upon the non-grantor spouse's death, pass into a bloodline, family, or dynasty trust, tax-free. There's also, one of the concerns is if a grantor spouse, a grantor were to die after, let's say the non-grantor spouse were to die before the grantor spouse, that string no longer exists. There are certain provisions you could include to kind of keep that string attached. So the Spousal Lifetime Access Trust, I think, has a lot of benefits that can help utilize the estate tax exemption and still keep access to the assets given away. So this is something for married couples, certainly one of the top strategies that we would recommend, to utilize your estate tax exemption, get the assets out of the tax system, the estate tax system, and still keep a string attached. Okay. And then, as I mentioned, the Grantor Retained Annuity Trust, this is the ability for you to transfer investment assets and retain an income stream for a period of years. The example I have here is creating an investment LLC. You're able to maybe retain control that way. You can transfer non-controlling interests in the LLC, take advantage of a discount. And the example I have here is $1 million of LLC interest gifted, taking a 30% valuation discount and having $700,000 as the gift value. You'll see the taxable gift is 0. That's because in the Grantor Retained Annuity Trust, the grantor is retaining an income of 6.9% per year payment for 15 years. And under the current rates, that produces a 0 taxable gift. So here I'm able to take $1 million, transfer it into a trust. If the grantor survives the 15-year term, that asset will pass tax-free, estate tax-free, to beneficiaries. It can pass to children outright. It can pass into a trust. If it passes into a trust, you just have to be cautious with generation skipping, because there may be a generation skipping tax event at that time. So that needs to be reviewed. But here, the grantor can retain an income for 15 years, transfer an asset worth $1 million for $700,000, and not use any of their gift tax exemption. Again, you can lower the GRAT payment and have part of the tax be a taxable gift. But it certainly is a great strategy to use right now with low interest rates. So one of the other strategies that I haven't put up here is something called a charitable lead annuity trust. For those clients that are charitably inclined, a charitable lead annuity trust in a low interest rate environment can provide a significant tax deduction today and pass assets to the family in the future. So that's another strategy that should be considered in a low interest rate environment. So a lot of information, a lot of planning to be done. I